You're watching gold hit record highs right now. Silver is surging. Central banks are hoarding physical metal at the fastest pace in decades. And if you look past the headlines about China dumping dollars, what's actually happening is far more important than whether you should buy gold today or not. This is about what it means when the world's financial architecture starts to crack in slow motion, and why that matters more to your personal wealth trajectory than whatever asset happens to be rallying this week. Let's start with what just happened. China announced it would reduce its U.S. Treasury holdings by roughly $200 billion over the next 18 months. That's not speculation, that's policy. And the market responded exactly how you'd expect when the second largest holder of U.S. debt signals it stepping back from the system. Gold jumped 8% in 48 hours. Silver followed, up 12%. But here's the thing most people miss when they see those moves and immediately think this is about buying precious metals. The real story is about what happens to your purchasing power when the underlying assumptions holding up your financial world start to shift. For the last 50 years, the dollar has been the default reserve currency. That means when countries trade with each other, they settle in dollars. When they save, they hold dollars. When they borrow in dollars. This creates a structural demand for U.S. debt that has allowed the United States to run deficits that would collapse any other country. You get to print the global reserve currency. You get to export inflation. You get to borrow at rates that don't reflect your actual fiscal position. And the people holding those dollars and that debt are effectively subsidizing your standard of living. That subsidy is what's quietly unwinding right now. China isn't doing this because they woke up and decided dollars are bad. They're doing this because the geopolitical cost of holding dollars has finally exceeded the economic benefit. When you hold another country's debt, you're exposed to their policy decisions. You're exposed to sanctions. You're exposed to the risk that they freeze your assets, which is exactly what happened to Russia after Ukraine. China looked at that and ran the math. The yield on U.S. Treasuries doesn't compensate for the risk of holding a massive position in an asset that could be weaponized against you. So they're rotating, not out of panic, out of rational self-interest. And when a major player rotates out of dollars, they rotate into something. Gold is the obvious candidate because it's the only asset with no counterparty risk. You hold physical gold, you don't need a government or a bank or a clearing system to honor that claim. It just is. That's why central banks buy it when trust starts to erode. It's not about getting rich. It's about preserving value when the system that underwrites everything else starts to look fragile. But let's pull this back to what it means for you. Because the average person hears gold is rallying and thinks they missed the trade. That's the wrong frame. The trade isn't the point. The point is that if the dollar's dominance is eroding even marginally, the cost of everything priced in dollars is going to adjust. And if you're sitting in a system where your income is denominated in dollars, your debts are denominated in dollars, your retirement account is priced in dollars, and your expenses are inflating faster than your income, you're holding a currency whose purchasing power is under structural pressure. That's not a scare tactic. That's just math. Let's run the numbers. The average American household earns about $75,000 a year. That household is spending roughly $68,000 a year. That leaves $7,000 in discretionary income before we talk about savings, investments, or any kind of financial buffer. Now, inflation over the last 3 years has averaged around 5%. That means the cost of goods and services is compounding at 5%, while wage growth is compounding at maybe 3% if you're lucky. Over 10 years, that gap turns a $7,000 margin into a structural deficit. Your expenses grow faster than your income, and the only way to close that gap is to either earn more, spend less, or go into debt. Most people choose debt because it's the path of least resistance. Now layer in what happens if the dollar loses even 10% of its purchasing power relative to other currencies or to hard assets over the next decade. That's not a dramatic scenario. That's what happens when demand for dollars softens and supply stays constant or increases. If your $1,000 income buys 10% less in real terms, you've effectively taken a $7,500 pay cut. That's your entire margin. Gone. And you didn't do anything wrong. You didn't make a bad investment. You just held the wrong asset, which in this case is cash, while the system around you repriced risk. This is why gold rallying isn't just a market event. It's a signal. It's telling you that large, sophisticated players are repricing the probability that the dollar stays stable. They're not betting on collapse. They're hedging against erosion. And if you're not thinking in those terms, you're assuming the system stays exactly as it is. That's not a reasonable assumption when the biggest creditor nations are actively diversifying away from your currency. So what does this mean in practical terms? It means you need to stop thinking about wealth as a number in your bank account and start thinking about it as purchasing power that compounds or erodes based on what you hold and where you deploy capital. If you have $100,000 sitting in a savings account earning 0.5% interest and inflation is running at 4%, you're losing 3.5% per year in real terms. Over 10 years, that $100,000 is worth $70,000 in purchasing power. You did nothing and you lost $30,000. That's not hypothetical. That's the default outcome for holding cash in an inflationary environment. Now compare that to deploying that same $100,000 into assets that generate cash flow or appreciate faster than inflation. Let's say you buy dividend-paying stocks that yield 3% and appreciate at 6% annually. That's a 9% nominal return. After inflation at 4%, you're still netting 5% real. Over 10 years, your $100,000 becomes $162,000 in real terms. Same starting point, completely different trajectory. The difference is where you deployed the capital and whether you understood that holding cash is an active decision with a cost. But here's where it gets more interesting. If the dollar weakens and you're holding assets that are denominated in or tied to hard assets, commodities, or international income streams, you're effectively insulated from that currency risk. Let's say you own real estate. The property doesn't care what the dollar does. The land is still there. The building is still there. And if the dollar weakens, the nominal price of that property goes up because it takes more dollars to buy the same asset. Same thing with equities, tied to companies that generate revenue globally or that own physical assets. You're not speculating on gold or silver. You're just making sure your wealth is stored in things that don't evaporate when the currency wobbles. This is the part most people don't internalize. They think investing is about picking the right stock or timing the market. It's not. It's about making sure your wealth is stored in assets that compound faster than your liabilities and that maintain purchasing power across different economic regimes. If you're young and you're building wealth, the biggest risk you face isn't a market crash. It's inflation eroding your savings faster than you can accumulate capital. That's the silent killer. And it's accelerated when the underlying currency you're denominated in starts to weaken structurally. China's move is a data point, not a conclusion. But it's a data point that fits into a larger pattern. The US has been running trillion-dollar deficits for years. The debt-to-GDP ratio is above 120%. The political will to cut spending doesn't exist. The Fed's choices are either keep rates high and risk recession or cut rates and risk inflation. Both paths lead to dollar weakness over time. It's not a conspiracy. It's just fiscal math and incentive structures playing out. And when the world's reserve currency is under pressure, gold rallies because it's the only asset that doesn't have a government balance sheet behind it. Silver rallies because it's gold's little brother and because it has industrial demand that increases in a green energy transition. But again, the rally itself is not the point. The point is what the rally tells you about where we are in the cycle. It tells you that smart money is hedging. It tells you that the people managing billions of dollars are recalculating the odds that the current system stays stable. And if they're hedging, you should at least understand why and whether that logic applies to your situation. So let's talk about what you actually do with this information. First, you need to know your gap. That's the difference between what you earn and what you spend. If you're earning $75,000 and spending $70,000, your gap is $5,000. That's your margin. That's your optionality. That's the capital you have available to deploy into assets that compound. If inflation runs at 4% and you're not increasing that gap every year, you're falling behind in real terms. You're working just as hard, but your purchasing power is shrinking. That's the treadmill most people are on without realizing it. Second, you need to think about where your wealth is stored. If it's all in cash or near cash equivalents, you're exposed to currency risk and inflation risk. That's not being safe. That's being fragile. Safety is holding assets that generate cash flow, appreciate over time, and maintain purchasing power across different scenarios. That could be equities, real estate, commodities, or a mix. It doesn't matter as much as the fact that you're not sitting in a depreciating currency pretending it is a long-term store of value. Third, you need to understand leverage and how it changes the equation. If you borrow at 3% to buy an asset that appreciates at 7% and generates income at 3%, you're earning 10% on that asset while paying 3% on the debt. That's a 7% spread. And if inflation is running at 4%, the real cost of your debt is negative 1%. The system is literally paying you to borrow. That's why sophisticated investors load up on productive debt during inflationary periods. They're not gambling. They're using the math to their advantage. But leverage only works if the asset you're buying generates cash flow or appreciates predictably. If you borrow to buy consumer goods or speculative assets, you're just amplifying risk. The difference between smart leverage and dumb leverage is whether the asset on the other side of the equation produces a return that exceeds the cost of capital. That's it. That's the whole game. Now let's talk about gold specifically, because a lot of people are going to hear this and think they need to go buy gold bars. Maybe, maybe not. Gold doesn't generate cash flow, it doesn't pay dividends, it doesn't compound. It just sits there. Its value is entirely based on what someone else will pay for it in the future. That makes it a hedge, not an investment. You hold gold as insurance against currency collapse or extreme inflation. You don't hold it expecting it to make you wealthy. It's a store of value, not a growth asset. Silver is a bit different because it has industrial use. It's used in solar panels, electronics, batteries. So there's real demand beyond just the monetary function. That gives it a floor. But it's also more volatile than gold because the market is smaller and the industrial demand fluctuates with the economy. If you're going to hold precious metals, the rule of thumb is 5 to 10% of your portfolio. Enough to hedge, not so much that you're betting everything on one scenario. But here's the real takeaway. Whether you buy gold or not, the underlying lesson is the same. You need to understand that your wealth is not secure just because you have a job and a savings account. Your wealth is only secure if it's stored in assets that maintain purchasing power and generate returns that outpace inflation and taxes. The system you're operating in is designed to erode purchasing power slowly over time. That's not a bug, that's a feature. It's how governments manage debt. They inflate it away. And if you're not actively protecting yourself from that process, you're the one getting inflated away. So when you see headlines about gold hitting new highs or China dumping dollars, don't think of it as noise. Think of it as information. It's telling you that the people who manage the largest pools of capital in the world are adjusting their assumptions. They're not panicking. They're just moving their chips on the board. And if you're sitting there with all your chips in one place, denominated in one currency, tied to one system, you're taking more risk than you think. You're assuming stability that the largest players in the world are no longer assuming. The goal here is not to scare you into buying gold or to convince you the dollar is collapsing tomorrow. The goal is to make you think about your financial position in terms of systems, incentives, and probabilities. The system you're in rewards people who deploy capital into productive assets. It punishes people who hold cash. It erodes the purchasing power of anyone who doesn't actively manage where their wealth is stored. And when the reserve currency itself starts to show cracks, even small ones, that process accelerates. You don't need to become a gold bug. You don't need to panic. You just need to understand that the assumptions you've been operating under might not hold for the next 10 or 20 years the way they held for the last 50. And if that's true, the decisions you make today about where you store your wealth and how you deploy your income are going to determine whether you're building real freedom or just running in place while the ground shifts beneath you.